Me. My name is Ian Harton. I'm the chair of programming at the CFA Society Ottawa, and I'm very pleased to be able to present to you two speakers. The first is Rebecca McKinnon. She is the founding director of Ranking Digital Rights at New America and author of Consent of the Network, the Worldwide Struggle for Internet Freedom. I'm also joined by Aaron Bennett, who is the managing director of Sustainable Investment Strategies and Research at Jodorowsky and Fraser. He is also a member of the advisory committee. He's also an advisory committee member of the UN-backed Principles for Responsible Investment. I'm very looking forward to hearing what our guests have to present to us today. So without any further ado, I will turn it over to Mr. Bennett.
Great. Thanks very much, Ian, and thanks for the opportunity. I'll just try technology and see if we can get this shared. So thanks very much for the opportunity. I think what I hope to do in the next 15 or 20 minutes is just give you kind of an investor's perspective on ESG and big tech and some of the things that we look at and how it influences what we do. These are the things I want to cover. It's really thinking about big tech in the real world or in real life. It's an acronym I was taught by one of my teenagers. And then talk about the environmental side of things. Talk about the S, which has really become a lot more prominent, and then governance and government. And then try and provide you with a few tools and frameworks that I've found useful and my firm's found useful. So when you think about in real life, it's really been there's really been a lot of headlines and they're really quite concerning, and some of this is to draw your attention to it and to drive engagement, but we don't see a lot of the potential positives or the utility of this. However, when you really sort of step back and you think about what's going on in real life, and I think some of these numbers are really just kind of astounding for me. And I'm not really a Luddite, but when you think about something that is intangible, which is one of the challenges of thinking about big tech when it comes to investing and things like that, it's something that's intangible, but tangibly useful. And that's really allowed it to scale and to penetrate our lives at a phenomenal speed. And when you really think about the penetration rate that's happened over what is really just part of a lifetime, it's truly astounding that it's come to this, where we've got almost half the world on social media of some kind, and you've got more than half the world using mobile phones, and I think that's truly incredible. And from an investment perspective, that tells you there's something really kind of important and going on. So from an economic impact, I mean, I really think back to, my first email in 1991, my first BlackBerry, if anyone remembers those, in 2001, and more recently, just spending more than a year in my basement office with a high-speed internet connection, as really mine and my family's primary source of work, social interaction, entertainment, and education. It's easy to use the developed country perspective and believe that the internet and technology boom is done. We've reached peak penetration. But I think this shows you the graph in the top left, where it talks about global online penetration, that there's still a meaningful chunk of people out there in the world that don't have access to the internet. And that tells you something, that provides you with an opportunity. Now, obviously, investments have to happen and things have to happen, and cultures have to change. But it's there, and it's an opportunity, and it's a significant runway. In addition to that, even when you think about the specifics of e-commerce and you look at the graph where we're looking at the share of total retail value, it's really quite small in the US and in Germany, two developed countries. It's gone off like a rocket ship in China. And I think that you've still got, even in a place like China, a growing market, 3/4 of the value of products sold that is not going through e-commerce right now. I don't know if anyone can really imagine at this stage life without the various streaming services right now, but you can see that it's still very early days. These are hundreds of millions of people that are using this. So the total accessible market of this is massive and really significant. So from a global economy perspective, this is something that has had an impact, continues to have the impact, and really has the runway to do so. So what does this mean to investors? So from the Bay Street, Wall Street perspective, you know, what do we think about this, and why is it related to ESG? And I think that these graphs sort of lay out the argument here. As anyone in active management knows, our industry is under pressure due to growing interest in passive products, especially for fixed income and public equities, and really more efficient markets that have really sort of narrowed the ability to extract alpha for investors. Except when you're talking about ESG labeled strategies. You can see this, you're seeing lots of flows where you've seen other active strategies, you've seen flat to down flows over the course of the year, and this is a trend that continues back for a number of years. But recently you've seen an acceleration of the flows going into ESG. So folks are interested. And the performance has been there as well overall. So how are these funds positioned? And I think that's something else to consider. Is they do have overweight positions in information technology, but not as much as materials or industrials. So maybe technology doesn't feature quite so highly in big tech. But then when you go to the bottom and you look at the market cap share of the S&P 500 in the US, that's made up of big tech, of really just 6 names out there, the so-called FANG M. It's massive. This is a quarter of the index. So if you're overweight this relative to the index, you've got a sizable position. And some evaluations say that as much as 20% of these ESG funds or more that have outperformed the market in the last number of years, they've done so because of a big overweight in tech. So if you're overweight tech, you're overweight in a significant way. It's a big money investment. I think it's important to note that even though we've seen some negative movements from inflation concerns recently, and we've seen some derating as some of these businesses mature and some questions happen about the total growth, is there's still a significant premium to the S&P 500 in terms of the PE multiple that these trade at. 2 to 2.5 turns, I think is pretty significant. In China, we have seen success and domestic leaders emerge, with almost 1 billion Chinese online and playing in one of the biggest markets in the world. However, they have been hit with their own concerns about regulation and government intervention and control. And although these are a smaller part of their domestic and global diversified indices, they're global scale players and taking unique paths that are available only to them due to the closed and emerging nature of their markets. So really important to think about. So before we dive into the details around ESG and big tech, I wanted to step back and describe my approach and my firm's approach, because ESG and sustainable investing can mean all sorts of things to different people. And folks aren't wrong. This is a tool, and this tool can be used in different ways to achieve different goals. So although we do run a number of specialized SRI or values aligned mandates that will exclude certain sectors or actively manage other portfolio characteristics like carbon footprint, the core of what we do is we use ESG to improve our ability to better manage risk or capture returns for our clients to provide superior long-term risk-adjusted return. This means that our investment team focuses on analyzing what they believe to be the financial and ESG elements that are the most material with regards to their investment thesis. And this is a long-term investment thesis. It's not next quarter, next year, it's 3, 5, 7 years out. We don't think that good ESG will fix a bad business or mediocre stock picking. But as this graph from the Harvard paper shows, focusing on what is material is also related to superior shareholder value creation. So we feel that this is something that can't really be currently done with just public disclosures and third-party scores. It's an area of inefficiency, which as an investor, we should always be looking for, because these areas of inefficiency are where we can find value when you can demonstrate a deep understanding of the companies you invest in and the trends that impact them. So let's start with the less obvious set of factors, the E. So in terms of absolute footprint, tech's pretty low, particularly compared to industrials and extractive industries like oil and gas. but their customers and users are looking to them as an easier source of value chain emissions reductions, because really they only have a couple of big areas of exposure, and data centers are one of them, and one that you often hear about. I think even in the last day, we've heard a lot about Tesla and Elon Musk saying, I'm not going to accept Bitcoin anymore because I'm worried about the carbon footprint of this. And we've seen lots of concerns about the growth in internet traffic and data center workloads and what that could do to the carbon footprint of the internet and big tech as a whole. And in fact, what you find is data center energy use has been flat to slightly down over time, because of a lot of the efficiencies that the companies have worked into this. And that's really impressive. I think in addition to that, when you look at global power purchase agreements, big tech has played a significant role in this. And this is something that has played a role in catalyzing investment in renewable energy and new sources, and can really backstop new projects. And that's something that's really allowed the overall industry to advance and costs come down, but also the overall net carbon footprint to really get adjusted. So how does this look from an individual company perspective? So broadly speaking here, when you look at this, the US big tech names are well ahead of the Chinese ones with regards to reductions, as well as commitments to further reductions in alignment with things like the goals of the Paris Accord. US big tech is not a monolith though, and it's not solely about the environmental footprint of data centers. Amazon has a massive real estate and transportation footprint that they have to deal with, and you see that reflected in some of these numbers and some of their commitments. And Apple has a significant hardware manufacturing and packaging exposure as well that needs to be addressed. It's difficult to see how much more the US big tech companies could do at a high level on this front, but there are opportunities to accelerate reductions with innovation and directly powering their operations with renewable energy rather than just offsetting it, and expanding their commitments to their overall value chain. It's important to remember that everyone says they're aiming towards net zero, but net zero can mean a lot of different things to a lot of different people. The Chinese companies are ostensibly aligned with the goals of their government, but have done very little in terms of public disclosure and big commitments, while their emissions have generally been on the rise. Now, this is not bad or good. This is just the nature of where they're at in terms of this journey. And in some respects, this could be an opportunity for the companies to attract external capital that worries about these things, but also to increase efficiencies, because we're now in a situation where the technology and the ability to lower these emissions and have that drop through to your bottom line has really grown over time. So let's move to the S. I'm sure many of us can sympathize with the couple in the picture. As social media becomes a source for helpful news, like where to get vaccinated, thank you, vaccine hunters, a great news source on Twitter that if you haven't found, you should, and less helpful news, like the grocery store shelves with no toilet paper or yeast. I'm not sure how either of those things will help you with the virus, but it was something that induced some panic. The pandemic has really heightened the need for many of these services, these big tech services for our work and personal lives, leading to some impressive resilience and growth for many of the companies on the profitability side of things. However, it's also increased the magnitude and the likelihood of the associated impacts, both positive and negative, on society. So diving into some of the specific issues and their societal and related business impacts, I want to make the point that all of these are risks and opportunities for these companies that may or may not be reflected in the current financials, the forward outlook, or the valuation of the individual stocks. These are a number of issues that come up a lot with our investment team when we talk about the big tech companies in our client portfolios. But all of them, and the reason we talk about them is because they have an impact on the financial outcomes. So the US elections have become an illustration of how challenging an issue something like content moderation is for companies like Facebook and Twitter. You do it too aggressively, you'll clamp down on free speech, you'll grow expenses and lower revenue growth from a lower user growth and engagement. If you don't do it in a sensible and transparent way, you can lose customers and users, and that's really the core of your business as well. Security and privacy is an area that is undergoing massive changes right now, with Apple clamping down on apps getting third-party data from our devices. Google is moving away from cookies, and governments and individuals are wondering who's listening in on their conversations and watching their activity. As the scrutiny gets higher, and user data becomes less accessible, the ability to target ads and sell user analytics, which is core to the business model of many of these companies, may force significant changes in business models to provide individuals more control over their data and how it's used. That may increase the cost of service for users, and it may also have other unintended consequences where it creates potential competitive barriers to grow for new entrants because of the higher costs, the longer investment periods, and the greater value of existing first-party data, the idea of a walled garden. An area of that's growing in relevance is really the use of the services for many of these companies, particularly when it comes to data and surveillance, as well as the transparency in their supply chain to create these products. Many of the big tech companies, both in the US and China, have artificial intelligence and image recognition software that can be misused by other groups, including the police and government agencies, in a way that can have a negative impact on human rights. Not having a process on this can result in a higher rate of misuse, declines in users, and decreased demand from non-governmental customers who just want to distance themselves from any company that's engaged in this activity. Not complying with requests or limiting the scope of the request too much is likely to strain your relationship with the government, which in an industry that's under increasing risk of regulation is something that you have to manage as well. Like many industries, the supply chain of big tech is global. Investors, consumers, and ad customers want more assurances that the products they are buying or have their ads associated with on the side of their screen are not the product of some extreme form of forced or unsafe labor conditions. However, at the same time, companies view the details of their procurement and manufacturing strategies as commercially sensitive. So there's a line to walk when it comes to disclosure and thinking about what you need to disclose. So we'll move on to governance and government. And I guess the GIF will play here too. In many ways, governance should be the first, but GES or GES doesn't sound like a great name for an investment tool. If you get the G right, it allows the company to think and adapt in a way that makes business more able to capitalize on long-term opportunities and manage exposure to long-term risks. This is true for both financial and material ESG issues. Big tech has a founder culture that very often puts disproportionate control in the hands of a few individuals with significant economic interest, but not the same as their voting interests, with things like dual class shares. In general, these structures are not seen as best practice, but empirically, there's evidence that for a period, not forever, post-IPO, it can be linked to outperformance. The ability to act without needing to build consensus among all the market participants that may or may not have long-term views can allow companies to get through that initial stage of the IPO and really make the investments that may have negative short-term consequences, but have superior long-term value creation opportunities. However, given the pace and scale and scope of change in these businesses, it seems reasonable to assume that at some point, management and the board will at a minimum need access to additional resources or a process of succession and renewal. External independent committees of experts are a good first step. But as we've seen with Facebook's so-called Supreme Court and Google's ethical AI initiatives, there's work to be done to really align these efforts with the broader business and make them a bit more impactful. Now, one of the few things that politicians appear to agree on is that big tech needs to be regulated, though the motivation and methods differ. So it's difficult to watch the congressional testimony as you see sort of playing in the background and not think that the US legislators are woefully underinformed and under-resourced to properly analyze, much less regulate these entities. The US leads on tech, but it is way behind on regulation. You could lack action and let others carry the baton, and then you get regulations informed by the EU and perhaps California that can increase costs and create significant headwinds on innovation and competition if it's not implemented properly. We've seen the same thing in China, where although they face fewer challenges as a state, as the state still overrides the private sector agenda, but they're still having some growing pains with multiple occurrences of CEOs advocating for greater freedom and less government intervention, only to be put in the proverbial penalty box. I would encourage any of you to dive down the rabbit hole on how the recent posting of a 1,000-year-old poem by the CEO of the Chinese online delivery service Meituan led to a 13% decline in a single day in the stock, just to get a sense of the tension that's going on between the government and some of these companies right now. So quickly, I want to go through a couple of frameworks that I think are really useful, and happy to answer questions about these, but I think we want to get to Rebecca's views as well, because I think there's a lot of really interesting content there that you won't normally see as an investor. But some tools that investors use: TCFD. On the climate side of things, this is the global standard, and it includes investment managers, and it does the best job of really giving you, here's what you need to disclose, here's what you need to think about, without prescribing what you have to conclude on all of these issues. So well worth your time to dig into. You know, SASB, or the Sustainable Accounting Standards Board, is a group that we've been involved with for a long time. I sit on their Standards Advisory Council. You know, they are an excellent starting point for investors because it focuses down to the sub-industry level, and you see a snapshot of what they do to find areas and metrics related to sustainability and ESG that are likely to have an impact on financial performance. So there's lots of other organizations that can provide insights on the wide range of practices in climate change reporting, responsible investing, good governance, and those things. But the most relevant for this conversation is, in my mind, the fantastic work that Ranking Digital Rights does when it comes to systematically evaluating the practices of companies in big tech and communications through a different lens to really provide a perspective and insight that can be hard to find in standard business circles.
Fantastic. Well, I guess that's my cue. I'm Rebecca McKinnon, and I'm going to share my PowerPoint here, and hopefully technology will just stand by one moment while I get it going. Here we are. There we go. Fantastic. Now I will just... There we are. Yes. Great. Well, thanks so much, Erin, for the kind words about my research project program, Ranking Digital Rights, which is a nonprofit research program housed at a think tank called New America in Washington, D.C. But we have staff really in many different locations, and we work with research partners around the world and increasingly collaborate with investors. And so I'm very pleased to be able to be talking to you today. And Erin provided a really fantastic overview of what some of the risks are, some of the governance concerns are. And I'm going to drill down further and give a taste really for how investors and people who work with investors can use the Ranking Digital Rights Corporate Accountability Index data and also our methodology and the standards that our methodology presents to both think about portfolio construction, but also to figure out what questions you need to be asking companies about. And increasingly, we're finding investors are using our findings and data also to put together their shareholder resolutions. And hopefully our data and insights can help investors push companies to get ahead of the regulatory curve rather than just wait to get regulated and fail to deal with the regulatory risk. While the U.S. Congress is always an interesting ride. I think we are likely to see some antitrust regulation coming. I think we are more likely than we've been in a long time to see more privacy law coming, more cybersecurity requirements, which is something that we also look at, and also around intermediary liability, or what's known as Section 230 reform. There's certainly a lot of pressure to regulate there, to hold companies more directly accountable for the content appearing on their sites and platforms. And of course, in Europe, we have the Digital Service Act. We have a lot of antitrust movement, as Aaron talked about, in a lot of different countries, and actually a new privacy law in China as well, that's already starting to have an impact. And I'll touch on that as well. So let me just see if I can get my slides to move forward. Here we are. So the Ranking Digital Rights Corporate Accountability Index, we've now put out 5 iterations of the index, roughly annual. And the 2020 index, which came out earlier this year, evaluates 14 digital platforms and 12 telecommunications companies. And we try to go for really what is a sampling of the world's most powerful digital platforms and telecommunications companies across the world. So when you combine them, they are really influencing the digital lives of most internet users on the planet. Of course, we'd love to be able to rank many more companies for resource reasons. That this is the set that we are able to evaluate at the moment. And we are evaluating them on 58 different indicators that relate to many of the things that Aaron was talking about, but drilling down very specifically to what companies ought to be disclosing, what their practices need to be, what their governance and oversight needs to be in order to be mitigating the risks to freedom of expression and privacy, which, and I'll talk about kind of what we mean by those terms in a moment. And also kind of what types of governance and oversight need to be in place if a company is going to be mitigating risks to users. So I'll go ahead. Let's see, why is this not advancing? Here we go. So this is the overall ranking itself, and you can go to the website and click around and see kind of what contributed to that ranking. I would just point out one thing. Amazon was added to the index for the first time this cycle. They are at the bottom. They're in pretty much everybody's portfolio, I would imagine. We just published an investor update, sort of a smaller kind of newsletter for investors that really translates our findings to what is most useful to investors. And Amazon, you know, it's ranking at the bottom, not necessarily because it has the absolute worst practices, but it's disclosing very little. It's demonstrating very little governance and oversight over its digital rights risks. So in terms of transparency and accountability around how it's managing its risks, it ends up at the bottom below Chinese companies, Russian companies, et cetera. So that's, and we can talk about that a bit more later. So what are we looking at? We have 3 basic categories of indicators. And the first major category, which is most familiar to investors, is governance. So we have several indicators that look for evidence that the company has robust practices in place and processes to ensure that not only that they have policies, human rights policies that include freedom of expression and information, as well as privacy and security, but that there is actual implementation, that there's risk assessment and due diligence, and that there's remedy in line with the UN guiding principles on business and human rights. And what we found is that over time, over the 5 cycles that we've done this index, more and more companies are putting in place human rights policies. For example, Apple only just put in place a human rights policy last year, amazingly. But so we're seeing more and more of commitments being explicitly stated. But when it comes to remedy, a lot less. When people who use the products and services around the world actually want to be able to go to the company and get redress if they feel that their rights were violated, there's a lot fewer mechanisms in evidence, and human rights due diligence around what is the company doing to really understand where its risks are, how users and their communities might be harmed by any aspect of the company's business. Is there comprehensive due diligence? It's very weak. We see some companies doing due diligence around government censorship and surveillance in some jurisdictions where they operate, but very paltry due diligence around other aspects of risks. And I'll talk a bit more about that later in my presentation after I explain a bit more about our methodology, so that will make sense. And so moving on, so these are the governance category scores specifically, and this is from the several governance indicators. You'll see that Twitter, which is on the top of the index overall, mainly because of its freedom of expression scores, but also parts of the privacy category, it's doing less well. Microsoft has the most robust governance among digital platforms. Telefonica in Europe, which is all over Latin America, is the most robust. And I'll talk a bit more about kind of in what ways in a little bit. But again, this is an example of how just because a company has an overall score once you start to drill down at the specific questions, you start to see very interesting patterns. And again, Amazon's governance very, very close to the bottom there with its Chinese colleagues. Another category that we look at is privacy. And what do we mean by privacy? We are looking for companies to disclose the policies and practices that demonstrate how the company is working to avoid contributing to violations of users' privacy. So we're looking really who has access to, if I use your service, who has access to my data, under what circumstances might it be shared, and how much control do I have over the collection and use of my data? So we're looking for transparency around how companies handle government demands for user data, and do they have due diligence processes around that. We're also looking for transparency, of course, around what is being collected for commercial purposes, also how people might be targeted for advertising, how people are profiled, how algorithms might be used to target people, and how much control people have over their data. We're also looking for clarity, about security standards. We don't expect companies to reveal information that will enable hackers to hack them more easily. So sources and methods, we're not looking for disclosure, but we are looking for basic disclosure about, do you have third-party security audits? do you have what's called a bug bounty program that enables security researchers to alert you to security flaws? And do you have clear oversight? Are you notifying users about data breaches, things like that? We want to see transparency and accountability around that. And so a couple examples of some of our indicators that gives you a sense of drilling down on the data and how it can be useful. So this is one indicator in the privacy category where we're looking for companies to disclose what options that users have to control the company's collection, inference, retention, and use of information about them. And there's a bunch of sub questions. You can click on the elements and kind of see what the sub questions are that enable us to find the answer to this. But you'll see that Facebook is very low on that on that particular indicator, which relates to its business model, right? It doesn't have an incentive to give users a lot of control, but that everybody's score is very low on this indicator, and you'll see that actually a Chinese company, Alibaba, is doing a little bit better than many others, and that relates actually to some extent to privacy law and security law in China. And I can talk a bit more about this later, but we are seeing that Chinese companies, when it comes to risks that don't relate to government demands, so consumer protections, to consumer data protections, cybersecurity protections, Chinese companies actually do have more disclosure in comparison with some of their American and European counterparts than I think the conventional wisdom might assume. So that's very interesting. And moving on. So this is another one of our privacy indicators that looks specifically at security oversight. So this is, does the company clearly disclose basic information about its institutional processes to ensure the security of its products and services? Amazon discloses nothing. They got a 0 in this indicator. Apple got 100%. It's a very interesting breakdown with some Asian companies near the top there, and some American brand names further down. And this relates very much to regulation. So that's, although obviously, Apple and Microsoft, their brand is very tied up in security and privacy, and so they've had incentive to do this anyway. But this is an area where regulation could really be quite helpful, but also investor pressure would one would hope could also help bring this up a bit. The final of the third categories that we examine, and I've saved freedom of expression and information for last, because there's a lot of misunderstanding about what freedom of expression means. In the human rights, in the framework of human rights standard, freedom of expression doesn't mean free for all, you can do anything you want, right? That's a state of nature without governance. And that's not what we're looking at. We expect companies to have rules and to enforce those rules. And under human rights law, you can restrict freedom of expression to protect the rights of others. The issue is that that the restrictions need to be necessary and proportionate, and not violate rights in carrying out the restriction that is disproportionate. So we're looking for companies to respect freedom of expression as articulated by international human rights instruments. And we want to see, yes, it's good for companies to have rules, because otherwise their platforms will be misused in ways that violates rights to life and liberty, right to free and fair elections, and other things, as we've seen. But we need transparency and accountability about how the rules are formulated and how they are enforced. Transparency about how the company responds to government and other legal processes that restrict content, so copyright enforcement or defamation takedown demands in many jurisdictions, that there be transparency around that, how that works. Identity policies, again, that's a big conversation, but can people actually speak online without being tracked in many countries where your identity when you speak might cause you not to be able to speak. And then issues related to network shutdowns. Increasingly in many countries with telecommunications companies, telcos are being required to shut down access to the internet entirely. This is happening a lot in India and parts of Africa, and we need to have accountability and transparency about why and how that's happening, so that policy advocacy can then address the problem with governments. So that's kind of how freedom of expression generally works. Just to drill down on that a little bit, given that there's a lot in the news these days, as Aaron pointed out, around deplatforming, and this guy with, who was kind of orange, who used to run things, and that is no longer on social media, or not on major social media in the United States these days. And of course, this whole issue of companies' power to set rules and enforce rules, and how are they being set and enforced, and to what extent can government have a say in that? Of course, in the United States, with social media companies, the First Amendment prevents the government from interfering too much directly. And so this is left to private companies, enforcement for the most part, although in many other jurisdictions, there is more direct regulation, in many countries in Europe, and obviously elsewhere and beyond. And so, that we're engaging in a very robust debate about how much power is appropriate for private companies, but also, if government regulates too heavily, what is that going to mean for freedom of expression? And so we actually did some research, some related research on this, last year, as we were kind of adding some indicators to our methodology related to companies' business model. And there's a link here to a report we produced last spring, that really kind of explains some of our indicators that relate to freedom of expression. That, and we hear a lot from investors of, should we be pushing companies to just take down more content? And one of the things that we try to understand, or try to unpack and help people understand, is that with social media, there's the issue of, can people post bad things, awful things? And then there's a question of, is it actually illegal what they posted, or is it just kind of lawful but awful speech, that when posted in isolation may not be very harmful, but if it is amplified by powerful people and repeated enough, and reposted enough, then it is harmful. What do you do? And so we looked into the extent to which the business model is at the root of the problem. Sorry, I'm going backwards. And we focused on two different things that are reflected in our indicators, as well. That, with Facebook, for example, or YouTube, in terms of what is recommended to you, that's based on algorithms. And also, you see advertising that is targeted to you because the company has collected very granular, detailed information about you and shared it with advertisers, who then target you with specific messages. And the way in which people are targeted by messages, and to be an advertiser, you just have to pay to boost content. You don't have to be some huge corporation. That whole system, these systems are very opaque and unaccountable. Users have very little control, and these systems play a big role in the spread and power of disinformation, which often is spread by organizations that actually devote a lot of resources to targeting the content of specific audiences. And you have algorithms as well that are based on profiles, helping to target the content at specific people, and recommending content to us based on what the algorithm guesses you're going to be interested in. So different people see very different things in their Facebook feeds or Twitter feeds, depending on who they are. And we don't have sufficient control over how content is recommended to us, how we are targeted, whether we are targeted. And so our algorithm, our indicators are asking questions about the amount of transparency that companies provide about how these systems work, and also how much choice they're giving to users about the extent to which they are profiled and targeted at all, or what information is used by the algorithm to recommend things to them. So we have a lot of indicators that get into that quite granularly, but I want to return to a couple of our governance indicators that relate to our companies even conducting due diligence about the impact that their content moderation systems even have on users and their communities, or targeted advertising, or algorithmic recommendation. Are they even doing any due diligence about it? And as you'll see, this one indicator here, it's kind of part of our impact assessment family of indicators. Very few companies as of last year were doing any due diligence around their content moderation. And similarly, with algorithmic systems that are recommending content, very few companies, even fewer companies, were doing even less due diligence around their algorithmic systems that recommend content. And you'll see Telefonica from Spain, which operates around Latin America, and which increasingly is in the content business in different ways, is really the, is an example of how it's actually possible to do this type of due diligence, but nobody is. So that's sort of an example to point to when companies kind of give you a response to your questions that are gobbledygook. It's not possible, we can't do it. Actually, you can do it. There's an example there. Targeted advertising. To what extent is there any due diligence being done around the harms caused by targeted advertising? Facebook has done some limited kind of specific due diligence in particular places like Myanmar and the United States, but not comprehensively. And so they're the only company that showed any evidence of doing that. Moving back to, I was mentioning Chinese companies earlier. We have on our website, in our 2020 index report, a whole spotlight about Chinese companies, and the very interesting trends that we've seen around Chinese companies actually responding to investor pressure, as well as regulation in China and elsewhere. And we do have some insights around, you're not going to be able to change Chinese tech companies' policies about how they handle government demands, but on consumer privacy, on security, on algorithmic transparency, it is actually possible to have an impact. And this is just breaking down a contrast between Amazon and Alibaba, two somewhat similar companies, not entirely, but they have online e-commerce and other things that are similar enough. Interestingly, on some indicators, Alibaba is much more transparent than Amazon. So particularly around content moderation, around its security practices, around commercial collection and sharing of information. When it comes to government demands for content removal or sharing of user information, that's where Amazon is being a little bit more transparent. But in general, that's kind of an interesting study in contrast there. That also show that there's a lot of room for investors to have impact. Also, I want to just show this chart that comes from our 2020 index report of the most improved companies, and Alibaba and Amazon are not there because we added them this past cycle. But you'll see that for digital platforms, we have Asian companies really, and a Russian company most improved, responding to their performance last time and making improvements. Apple's improvement had a lot to do with the fact that it finally released a human rights policy last year and has become more transparent around content, and a few of their privacy practices, which you know, they're quite good on privacy, but they're less good about disclosing what they do actually, which is odd. But they've made a big improvement. There was a big shareholder resolution last year around concerns about taking down apps in Hong Kong and Tibet that they've responded to with more transparency. So it's an example of how investors can make a difference. Also with MTN, based in South Africa, which operates around the developing world, investors, a number of investors from the Investor Alliance for Human Rights engaged with them quite actively, and they made a lot of improvements in the past year. And then moving on, we have a whole page with lots of recommendations for companies, and we have company report cards as well that kind of get very in detail about what each company did well and less well. But really, you know, investors can be just looking at what is your governance? You know, what do you not only have commitment, but what is your oversight? What is your due diligence? Are you working to account for and mitigate harms caused by algorithms, targeted advertising, aspects of your business model? How transparent are companies being, particularly how their platforms and services shape and target content, as well as how data is accessed and used and shared? And how much choice do users have about how their data is collected and used? Also, how content might be targeted and recommended for them. These are questions, and we have more kind of detailed suggested questions for investors in our latest investor update. And that's downloadable on our investor page. But again, oversight, due diligence, business model. Is the company evaluating and disclosing risks related to its business model? At the moment, we're not seeing sufficient disclosure and due diligence at this time. And then very quickly, before we get into our final moments of questions, in our website, we have some more details about shareholder proposals that are on the proxy ballots this year. There's a lot around governance. Again, looking for due diligence, looking for human rights, civil rights experts on the board, which are currently lacking. Looking for companies to produce reports, conduct due diligence on facial recognition, produce reports on how they're handling government mandated content removal. With Alphabet, whistleblower policies and practices, which has been a big issue for Alphabet. And then also, not in this table because it's not specifically digital rights, but it obviously relates. There continue to be proposals around separating the CEO from chairman of the board at Facebook. There continue to be proposals related to the investors' frustration with dual class shares, which, of course, with the dual class share structure, you know, at Facebook in particular, it's very hard for any shareholder resolution to pass, which is of course something that some people are hoping that maybe the Biden administration and the new SEC might be able to address. So just in closing, this is our investor resource page where you can go to download our latest investor update that gets into a bit more detail about our latest index and the relevant findings for investors, linked to our shareholder resolution table, and some contact information and some further links here to our index so that you can explore. And we do hope you'll stay in touch. And of course, this presentation can be shared, and people are welcome to get in touch. So thank you very much.
Great. Thank you so much, Rebecca and Aaron, for that presentation. I'd invite our guests to pose any open questions in the Q&A function, but I would like to start by asking both of you. You've mentioned that governments and shareholders are both able to apply pressure on the behavior of these companies, but I was wondering, to what extent do you think users also have power to affect change in these organizations by simply taking their eyeballs elsewhere.
Yeah, I mean, I could jump in. I'm sorry.
No, go ahead, Rebecca.
Yeah, well, Consumer Reports has been doing some really good work that's kind of trying to educate users on just kind of what's happening with these platforms and what you can do. One of the challenges is kind of what we call network effects. There are a lot of people who are on Facebook who'd rather not be on Facebook, but if you run a nonprofit or if you run a CFA society and you're not on Facebook, or a lot of organizations feel they have to be on Facebook in order to reach the audiences they need to reach. And so there's a chicken and egg, which is where antitrust and other things then kind of fit in.
And I'd say yes. I think absolutely users can apply pressure. Although, as Rebecca suggested, it does require a sizable portion of them. But I think it is always worth remembering that although the users get some utility out of this, and in some cases significant utility out of this, they are in some respects the product. And so if the product chooses to engage elsewhere and as options open up, if they can in fact open up, then I think there are opportunities. I think we've seen some interesting trends with regards to the retail side of things, and that dichotomy between Amazon saying they're very focused on customer satisfaction and Shopify saying, well, customer satisfaction is important, but we're also very, very focused on the retailers and enabling what they do and helping them grow their business. And so I think that you're starting to see, despite some of the network effect, some of those elements that suggest when a better option comes up and when competition happens, it does move companies in the right direction towards a more balanced approach to this.
Great, thank you. And since I don't see any questions in the Q&A function, I'll wrap things up by again thanking you so much for taking the time to present to us this afternoon. And to everyone who is logged in, I'd like to remind you that next month we will be hosting another educational event on impact investing featuring Andrew Knox of Franklin Templeton. And in July, we will be having an information session on an intro to crypto investing featuring Eric Richmond, the CEO of Coinbase. So I look forward to seeing you all there. And again, thank you everyone for attending.
Excellent.
Thank you so
Thank
much.
you.